Good morning, everyone. Thank you for joining us for the June 4th, 2026 JMBC regular meeting. We are still waiting on the quorum, so we will adjust the proposed agenda and take the informational items first, starting with item number 8, the committee report 26-16, projects and activities report.
Good morning, JLMBC. My name is Roby Ann Jamawis from the Employee Benefits Division. I'll be presenting the projects and activities report. Under informational updates, after 11 months of negotiations, Kaiser informed the city that members of the Alliance of Healthcare Unions ratified 52 collective bargaining agreements, which covers more than 61,000 Kaiser employees across various markets. Meanwhile, contract talks between Kaiser and the National Union of Healthcare Workers remain ongoing, with bargaining sessions scheduled through late April. For procurement updates for 2027 renewal negotiations, dental, vision, and EFAP contracts expire at the end of 2026. If the JLMBC approves the extension recommendations, staff will begin drafting amendments to extend them through December 31st, 2027. Medical, life, AD&D, disability, and tax spending accounts, the contracts expire at the end of 2027. So staff will present recommended actions to the JLMBC at a later date. The request for proposals or RFPs for the EFAP is receiving final sign-offs and will be issued on LA-RAMP. It's expected to launch in mid-May, with responses due in June and evaluation and wrapping up around August 2026. In terms of self-funding status, staff in Keenan are currently finalizing the self-funded premium equivalent rates, finalizing the estimated reserves, administration processes and organization, and creation of the trust account for claims, which will be brought back to the JLMBC tentatively in June. Draft ordinance development is underway to establish a new fund. Staff expects this to move forward in late 2026, remaining on track for the 2027 implementation. Transitioning to self-funding requires adequate staff training for HIPAA compliance, alongside securing physical and virtual office spaces to safely handle protected health information, or PHI, and staff is currently developing a plan for that. In terms of the Civilian Benefits Program Plan document, following the JLMBC's approval on March 5th, 2026, staff is drafting a request to the mayor and city council to propose an administrative code amendment for the governance, preparation, and maintenance of the plan document. Once the city council establishes this governing framework, staff will bring the final plan document back to the JLMBC for its review and final approval. Updates to the JLMBC live stream and YouTube channel. Prompted by the Information Technology Agency, staff is modifying the channel, adding a logo, description, updated link, and channel name as part of Google's channel verification process. And just to note, these adjustments did accidentally broke the previous published live stream link, but staff has fixed this by establishing a new permanent link, which you'll see in the report. And staff is also updating the channel's organization to make it easier for viewers to search for specific past JLMBC meetings. Update to the Senate Bill 707. It was signed into law and provided multiple changes to California's public meeting law for legislative bodies, also known as the Ralph M. Brown Act. It mandates that legislative bodies provide a two-way audio-visual platform for public attendance and translate agendas into languages spoken by more than 20% of the local population. Staff believes the committee is already compliant with these structural changes, and the current live stream and telephonic public comment options meet the platform requirements. And because no non-English language reaches the 20% threshold in the city or workforce, English-only agendas remain legally compliant. In terms of the staffing summary, staff is working on fulfilling the vacant account clerk position. And lastly, attachment A shows a calendar of upcoming board meetings and proposed topics. Thank you. That's it for me. Questions?
Thank you all.
Thank you.
Okay, we now have quorum and we'll formally start the JMBC regular meeting for today. First, we will go through roll call, starting with management and then the employee organizations. Malika Billups.
Present.
Tony Royster.
Here.
Matthew Crawford for Matthew Rudnick.
Here.
Paul Girard for Matthew Sabo.
Present.
Patrice Latimore.
Here.
Janita Iguelar.
I'm here.
Marlene Fonseca.
Here.
Chad Boggio.
Here.
Esteban Lizardo. Lisa Palombi. We have quorum. Before we start with public comments, I would just like to remind speakers that if when speaking, if you could please speak into the microphone. This will help viewers listening in on the live stream and calling in. It will help them be able to hear what's going on. Thank you. If you are participating via phone, please press star 9 and announce yourself. If you are in the room, please drop off your speaker card to the front desk. Apologies. Looks like we had skipped the call to order for the meeting.
Call this meeting to order at 9:09 a.m.
Thank you very much for that. So again, we'll just go over the just a quick update to the roll call to reflect that Lisa Palombi is now present. So again, for public comments, if you are participating via phone, please press 9 and announce yourself. If you are in the room, please drop off your speaker card. It does not look like we have any public comments for today.
So can we move to item number 3, approval of the minutes?
So for this action items, staff is presenting about 12 sets of minutes for the listed meetings to be approved. So I do apologize for the lack of for the number of minutes that are being approved, being requested for approval at this time. However, with this approval going forward, we will be caught up and are expecting to have meetings reported on a regular, more consistent basis going forward.
All right. Has everybody had an opportunity to review the minutes? If so, then can I get a motion?
I move.
Second.
We call the roll.
Taking roll call for the minutes. Malika, your vote, please.
Yes.
Tony, your vote.
Aye.
Matthew, your vote.
Aye.
Paul, your vote.
Aye.
Patrice, your vote.
Aye.
Janita, your vote.
Yes.
Marlene, your vote.
Aye.
Chad, your vote.
Aye.
Lisa, your vote.
Aye.
The vote is unanimous. The motion passes.
Okay, we'll move to item number 4, committee report 26-12, staffing and reimbursement.
Good morning. This is a staffing reimbursement request for the third quarter of fiscal year, which ended on March 31st, 2026. The recommendation here is that the JLMBC remove reimbursements from the Employee Benefits Trust Fund for the costs of staff providing administrative services in the amount of $710,057.36 inclusive of this third quarter and adjustments to the first and second quarter following reimbursement rate updates for this fiscal year. And then reimbursements from the wellness sub-account for the Live Well Wellness Program staffing support for a total amount of $93,596.44 inclusive of the third quarter for this fiscal year and the first and second quarter of the fiscal year adjustments. Are there any questions at this time?
No discussion. Is there a motion?
Moved. Second.
Janita made the second.
Okay. Okay, we will now take the vote for Committee Report 2612. Malika, your vote.
Aye.
Matthew, your vote. I'm sorry, apologies, I skipped there. Tony, your vote.
Aye.
Matthew, your vote.
Aye.
Paul, your vote. Patrice, your vote. Janita, your vote.
Yes.
Marlene, your vote.
Aye.
Chad, your vote.
Aye.
Lisa, your vote.
Aye.
The votes are unanimous. The motion passes.
Thank you. We'll move to item number 5, Committee Report 2613, our third-party administrator request for proposals.
Okay, I will be taking this report. So this report is regarding the TPA RFP. Staff is recommending that the JMBC do 3 things. First is to receive this report. Second is to approve the attached draft RFP, which is subject to final approval and city attorney, which is subject to final changes and city attorney approval. And thirdly, approve the proposed pledge form for the JMBC members and staff members involved in the procurement process. So the city has traditionally utilized a TPA to assist it in administering the LAWell benefits program. On page 2 and 3 is an overview of the current TPA as well as the service cost structure. So the last RFP was issued in 2017, and the selected vendor, TELUS Health, formally took charge on March 2019. The contract was amended and extended through March 2029 in response to the to transition timing concerns relating to the transition from Pacer to Workday. And that amendment also included some additional work to be performed by the TPA. On pages 3 to 7 is an overview of the more notable items that staff is seeking to address through the TPA RFP. These include, improved file feed changes, single sign-on, closed loop data reconciliation, programming flexibility, and communication improvements. As part of the RFP, a pre-proposal meeting will be held. And this RFP will be evaluated by staff alongside our benefits consultants who will be peer reviewing the RFP. And as a part of this RFP, we will also be including a system demonstration presentation, part of the RFP will also as part of the evaluation, will also include a system demonstration presentation. And then on page 9, we have an overview of the tentative timeline for this RFP. Staff is looking to issue this RFP next month with a pre-proposal following in August. Proposals are tentatively set to be submitted sometime in September, October, with recommendation being made to the JMBC towards the end of this year or shortly after the start of the new year. So that brings us to the end of this report. Is there any questions regarding the RFP itself or the report? No? Thank you. In that case, we can start with we can proceed with roll call.
We need a motion.
Oh, sorry.
And just to clarify, City Attorney, since it's a 3-part recommendation, can we make a motion on all of the staff recommendation, or do we need to take them individually?
I believe it's okay to do it all together.
Okay. Is there a motion?
Second.
Okay. At this time, we will proceed with votes. Malika, your vote.
Aye.
Tony, your vote.
Aye.
Matthew, your vote.
Aye.
Paul, your vote?
Aye.
Patrice, your vote?
Aye.
Janita, your vote?
Yes.
Marlene, your vote?
Aye.
Chad, your vote?
Aye.
And Lisa, your vote?
Aye.
The votes are unanimous. The motion passes.
All right, thank you. Item number 6, Committee Report 2614, LA Well Program 2027 Service Renewal and Plan Design Changes and 2027 Plan Adoption.
Good morning, everybody. Paul McCaskey, Employee Benefits. This is our big program renewal report that the JLMBC is going to recommend. We're going to bring to City Council for full adoption. This is the same process that we did over multiple meetings last year, but this time we're just doing it one big long slew. So there are 3 action items within this report and then 2 recommendation or just receive and file items. The first section, Section A, is going to go over the renewals of existing services that we have with all of our vendors, where they came in at the price point, what we're looking at for 2027 costs and services. Section B is contract extensions. Some of our service providers actually end their service agreement with us right now in 2026, but we still have room to extend. So that's going to be covered over Section B. Section C is going to be program changes that we want to make towards the actual functioning of the program and how it operates for 2027. D is an update on finance, and E is the actual council report itself. Both of those are just informational kind of items. It's a lot. So it is all something that we can take in segments. It is something that we definitely will talk about potential modifications to motions, should you want to make one. But it is important that we have to do everything all together, or we get to the end of this before we can move the report forward for council. So starting with Section A, any questions so far? Starting with Section A, if you could go to page 4 of the report just temporarily. In page 4, there is a summary of our current existing plan. These are the plan benefits that we have in force for 2026 and the proposed rate changes for 2027. You'll see all of the rates came in at either no change or a rate increase, no rate decreases. And we will have a lot of detail on this in the deck that Keenan has provided. So we'll switch over to the attachment A, which starts with page, I believe it's 37 of the physical report. But it's attachment A. It has people with no shoes on as its title page.
Yeah.
Good morning. I'm Terry Graff from Keenan. We're going to start by just going through the executive summary of the report, and the overall renewal comes in just in under 8%. That's typically a very favorable renewal, but when you look at it from how large the city is and the number of covered members, that 7.9 is a large amount. And there's a lot of factors that came into play. This was a particularly difficult renewal, and we've been negotiating for the last few months with the vendors. And that's basically because Blue Shield and United Healthcare are in their first year. So they've only got a couple years or a couple months of experience. And when they first created their renewal, they didn't have any experience to go by. They had January basically. And when you start a new plan, there's a lag in when the claims come in. And so, they're not really seeing much in January. So with that limited data, we're really relying on all of Anthem's 2025 data for the renewal. Also, those 2 vendors had a lot of uncertainty with the population they were going to get. So they made some assumptions going into the renewal going into the RFP about which segment of the population they would get. So didn't really know what they were going to get until, after the enrollment. Also, when we did the renewal last year, when we went through the RFP, we had claims data through June is what we used. That was pretty favorable experience. And then the last part of the year after we got the rates and finalized everything, the claims went up.
increased pretty significantly. And we think that's in part due to the fact that, you know, everybody was informed, we're making a carrier change, you know, kind of get your services done while you can, fill your prescriptions, you know, take advantage of your services now, because when you go on to the new plan, you know, there could be just, you know, we wanted to make sure that everything was as smooth as possible in that transition. So we think a lot of that later activity in the year was due to the fact that people were kind of accelerating their needs in the end of the year. Also just underlying inflation in general. So we're seeing medical inflation is anywhere between 9 and 11% this year. And prescription drugs is even higher than that, from 8 to 12%. So even if nothing else changed and everything was status quo, we would expect that those trend increases would apply, because it's just more expensive to deliver medical care. You know, GLP-1s is part of that. The new infertility benefits is part of that. You know, just general medical inflation, the cost of maintaining the provider network and giving them you know, providers increases to their contracts, et cetera. Also this year, Kaiser changed their rating methodology. So we're going to go into that in a lot more detail, but the intention is to basically smooth out renewals over time. So it's a long-term strategy for Kaiser, but, you know, it's beneficial in the long term, but probably going to hit the city a little bit harder in that first year. In terms of the non-medical renewals, on the dental side, we're seeing trend on that side about 4 to 5%. That's not going to be the case for the city. We actually came in lower than that, but we have the advantage of having some rate caps that were negotiated previously. Same with the vision. That renewal is, the trend is between 2 and 3.5% on vision plans this year. And we actually have a rate pass this year on vision. For the EFAP program, we got the initial renewal. That was a 13% renewal. We did negotiate a little bit with them, but because we have that upcoming RFP for the EFAP plan, we're hopeful that at that point we can have more favorable rating that will come out of that. And then on the life and disability, those are both under rate guarantee, so they are not renewing in 2027. Any questions so far? Okay. If we look at the enrollment distribution, now you've seen this a couple of times, but just as a reminder, Kaiser's obviously got the bulk of it, just under 17,000. And then the next largest group is under the Blue Shield PPO and the Blue Shield Trio plans. And then that's followed by the Signature Value Plan with UHC, which is the full network. And then the Harmony plan, which is the more narrow network. And then your cash in lieu. And then we've got just a little group that's in that high deductible health plan. And the demographic factors we put in here just so you could kind of see the risk that was picked up by the different carriers. So Blue Shield kind of fared a little bit better than United Healthcare with the average age of 46 as compared to United Healthcare's got the highest average age at 49. Kaiser's the lowest here. And then we also represented your cash in lieu, or the people that waived the plan. That's kind of an overall look at where things landed with the carriers. And then I'll turn it over to Borden.
If we look on the next page, we have a financial summary of all lines of coverage, all medical lines of coverage. Overall, for 2026, the estimated annual premium is about $514 million. If we look at the renewal based on what the carriers are requesting, that renewal moves up to about $555 million for an increase of just under $41 million. or 7.9% increase in the cost of coverage. Of that, we have Blue Shield at 11.7%, the PPO and the high deductible health plans at 12.9%, and the trio at 9.9%. For UHC, 10.5% renewal overall, with a 6.8 on the Harmony, and the full HMO at 11.9, and Kaiser coming in at 6.3. I will say that when we did the RFP last year, it was wisdom by this committee to put the rate caps in for 27, because that's what we're seeing come to fruition this year. We would have hoped that they would have been lower, but we avoided any type of higher increase other than what we received. So it was good that we've had rate caps put in place. On the Delta Dental, it averaged 2.7, the DHMO getting a rate pass, and the preventive and the dental PPO plan both at 3%. Anthem Vision is a rate pass at 0, and then the Optum EFAP coming in at 11.9 for the overall 7.9. The financials are the financials, so that's what we have. Any questions on those?
Are there additional 50 million? Is that all city costs, or is it some of the costs is related to employee contributions?
I can answer that. So both. So that is full premium. But that full premium is the subsidized portion of it is partially paid by proprietary departments. So the city's cost is closer to 400 something million. It's on a later slide.
Okay.
But to Tony's question, so that's city versus proprietaries, but is this also include the employee contributions?
Correct.
To that?
And we do have, which we'll get to in a second, I think, after Ed King is done. We do have some charts in the report that show the end pocket costs for employees, whether they're full-time or part-time. It is because the subsidy came in much lower than the cost increases for Blue Shield and UHC. There are some substantial increases out of pocket for some employees.
At the same time, we want to also know what's the impact on the general fund budget.
Correct.
Yeah.
And the impact on the general fund budget, I can already say, is exactly where we had estimated at when we had done our assumptions. So that was just a lucky coincidence, I guess. So the overall impact is not different from
Get credit for that.
from what
Skill and talent. It was wisdom.
We'll give you a clue.
Like business agent 101. We learned this in the first year. Like, yeah.
Brilliant work.
Take a W.
Yeah.
Awesome job.
Yeah.
Give you a clue.
Again, great wisdom by this committee. On the next page, we're going to go into a little bit of the underwriting methodology for Blue Shield and UHC. As Terry mentioned, this was a very, very difficult, because it's the first year the city of LA gets their renewals very early in the year. So they had 1 month of experience of their own, and then they had the conclusion of the Anthem experience from 2025 based off that they had to underwrite off of. And again, people made decisions into different plans. So who went into what plan and so forth between the two carriers was a difficult task for them. And so, and we've looked at we've gone back to them time and time again to ask or look at updated information. But even the first 3 months of any plan year, when you first implement, they're considered immature months. So they're not even fully credible in and of themselves. January was not a credible month. And what I mean by that is, yes, people went to Blue Shield providers and to UHC providers instead of Anthem providers, but they go, and then we have to be billed for those services. Those services could take 1, 2, or even 3 months or longer to materialize in the system. And because of that, the first month, yes, people use the plan, but the recording of the financials on a claim cost basis is not necessarily there. And so it made it very, very difficult. And thus we were at these. I will say that in our negotiations with the carriers, we asked them to look at more advanced tools in their underwriting, and this will continue to be the request from Keenan going forward, and we will push with our carrier partners because as we move into a new era of technology with AI and so forth, there is a lot of predictive modeling tools that are out there that can be utilized so that they can assess what the risk is of those individuals without necessarily having plan experience. Not saying that we're going to replace underwriting with AI. I wouldn't want to do that, but it gives them a second look at how to rate this. So I think for both Blue Shield, UHC, and even Kaiser to that matter, we will be pushing them to really develop in their underwriting the usage of newer technology to assess risk. On the UHC front, again, we also had the rate caps that came into play, and they had the same struggles that Blue Shield had relative to new carrier being put in place as well. Any questions about Blue Shield or UHC?
Quick question, if we didn't have the caps, what we anticipate our increases would have been?
That would have been at the discretion of the carriers because we still don't have the plan experience. So we can't necessarily project from an underwriting perspective, but they could have been higher. And from the data that we were seeing, taken with a grain of salt, the carriers were saying they could have asked for more. They would have asked. So definitely the rate
we're
caps.
seeing industry wise, no.
There's a couple of things that are really driving the industry right now, and we're going to get to a slide that's going to show you what we're seeing in the industry is an increase in cost, a hyper trend, if you will, in large claim costs. We're seeing more and more large claims, and in particular, a lot of this, and I struggle with this because I ask myself, how much more can employees and employers take relative to that? Because if you look at the healthcare system that we have right now, and if we look at any hospital, and I believe I shared this with this committee before, you have a hospital gets paid one of three ways typically. They get paid by Medi-Cal, they get paid by Medicare, or they get paid by commercial insurance. This is commercial insurance. There's no Medicare, there's no Medi-Cal that pays for it. The issue becomes Medi-Cal rates are set. Unfortunately, they're extremely low. They're about, I think California averages 72% of Medicare rates. And then Medicare has a set rate too. So hospitals and providers in general are set, unfortunately, with if they have increasing costs, increasing labor costs, where do they have to absorb this? It's in that commercial aspect. And that's why sometimes you're hearing our carrier partners, whether it's Kaiser, UHC, Blue Shield, Anthem, their negotiations are going well with a certain network that this hospital may be out of network soon. All of that is because of negotiations of the carriers trying to get a good discount for the members, and the hospital saying, I need this to stay afloat. So those are some of them. And then prescription drugs is a whole nother story as well too.
One thing quick to add there is that both UHC and Blue Shield have agreed to take another look at claims at the end of July. So, if there's more favorable experience, that will be taken into consideration.
And if they're not, our rates still stay the same?
Yeah.
I have a question, maybe more general. When we have transitions like this, and we know, right, that the renewals are coming up shortly after the new carriers come in. I mean, is there anything that, like, do you guys try to negotiate a rate cap for the first year when it's a new carrier? Do they refuse? What's the deal?
So, well, the For the second year.
Yeah,
For the
second.
first, yeah, for the first year, we have
Right,
what the
I think
RFP won. And for the second year, yes, when we had the RFP proposal, there were rate caps that were negotiated and set at that point in time.
For year two?
Yeah, that's what we're having right now.
Oh, and these are the rate.
And these are, they're,
On the Blue Shield?
yeah, Blue Shield and on
UHC.
UHC both.
Okay, okay, I get it. I see.
Yeah,
So those, okay.
yeah. And then, any other questions? Otherwise, I'm gonna move to Kaiser. Kaiser changed their underwriting methodology to basically, like Terry mentioned, to smooth out renewals, which yes, I get. But in the same token, they do what's called a 2-year look back now. So instead of, they always look back 1 year to look at your claim experience, now they're looking back 2 years. Well, you have a substantial population. 1 year experience should be credible in itself. The problem with looking at 2 years of experience is that now you're adding additional trend to the number. And it's supposed to smooth things out. I don't like it. I haven't done 2 years of underwriting since the early 90s. And I think at that time I was mimicking LA law with a puffy shouldered outfit. It for the immediate year, it appears that it did provide an advantage to you. However, that advantage came with Kaiser traditionally has tried to maintain its pooling levels of and each year we've seen the pooling level go about 25 to 50,000. Pooling is the point at which claims under the pooling level count towards your plan experience and are underwritten, where claims that hit above that are absorbed by Kaiser's pool and don't count towards the experience. So for instance, for right now in 2026, you have a $950,000 pooling point. So if an individual had a claim above 950,000, the plan experience would cover the first 950. The point above that would be absorbed by the pool and wouldn't count towards any future renewal increases and so forth. The methodology included a jump from 950,000 to 1,150,000. And so that's a 200,000. So basically what's happening is under the Kaiser plan, the Kaiser is requesting that the city take on $200,000 more in risk, which we objected to, and yet we're unsuccessful in having that lowered. And so where it gets even more convoluted is if you have an ongoing large claimant. For instance, if you had a claimant that in 2024 and 2025 was over $1 million, with this 2-year underwriting, you're hit with that twice. So rather than underwriting at 950 for both years, there's an additional 400,000 in there, 200 for each year. And so I wasn't really keen on that methodology either. Additionally, there's some underwriting factors that were included. And there's typically 3 factors that are adjusted before trend is applied. One is for change in demographics, another is for incurred claims, and a third is for future plan changes. I went back and I looked at the city's renewals for the last 10 years. And each year, if you add those 3 factors up, it's always about a 3% load, where Kaiser does have the lowest trend number. But if you add 3% every year, it's your low trend number plus 3%. And we tried to negotiate those as well too, and have them adjust. And we did have a minor adjustment that we did to the overall rate, but it's contingent upon a growth initiative, a very small one, 400 members. Yeah, so the renewal actually came down a little bit, or we're recommending a renewal decrease from 6.6 down to 6.3 to include that growth initiative. So, yeah, and that kind of summarizes the Kaiser negotiations. We'll have to see. This is Kaiser's first year of doing it, and the city of LA certainly was at the forefront of this 2-year underwriting methodology. As my other groups are now getting their 2027 renewals, Kaiser knows I'm on record that I don't really care for it. But they are a good partner to us relative to that, and we just have to work our way through that. So any questions on the Kaiser? Yes.
Growth initiative, would that be an initiative that the city is taking or that?
So
Kaiser is
it's almost kind of self-fulfilling, if you will. It's 400 lives. So they look at what their enrollment is currently, and if we hit a target of 400 more lives, the rate drops by 0.3%.
Who hits the target? We do or they do?
Enrollment.
So it'd have to be 400 new members in 2027.
Yeah.
The full year of 2020.
That's net growth.
Yes.
Yeah. And given where Blue Shield and UHC came in, where the rates will be falling and so forth, I really don't think that's going to be an issue. It should self-fulfill.
What is their annual growth normally?
Well, for years, they've been the default, and so they're.
Yeah, and we changed the admin code already, right? That's gone through
No. For the subsidy change, no.
for the default.
Oh, for the default, didn't need the admin code change. That was just our plan.
Okay.
change. And so that did.
So
change.
that's already implemented.
Correct. And so for 2026, Kaiser is not the default. But based on the premiums that we're seeing for 2027, Kaiser will become the default if these do not change. If the experience is not all for something. And so maybe that's a good segue to Keenan has the premium subsidy premium charts in their deck. But perhaps based on the feedback from the committee that we're getting so far, maybe it's good to go back to the report and look at how the premiums applied to the paychecks. It's the same numbers, but just a different point of view. So if we could go back to page 7, and starting with, this is in order by plan type, and then provider. So the Blue Shield Trio HMO is on the bottom of page 7. Someone in a family plan will be paying $34.38 a paycheck. So that's 2 times a month, where they weren't paying something before under the current rates. The next page is the halftime group. Halftime always ends up paying a lot more since we kept the subsidy at the employee only level. On page 9 are the Kaiser rates. Kaiser at the top, employee is not paying anything different because that is still the structure of the subsidy. On the top of page 10 is the UHC rates. The first signature value HMO is the plan where a lot of members who were accessing Vivity before went into, so they would be paying something almost double, a little over double actually, in 2027 on the family rate. And then somebody that's in the employee plus spouse rate would be paying $46 each paycheck on that plan specifically. And then at the bottom of the page on page 10 is the Harmony plan rate. So that does also have an increase for an out-of-pocket cost for an employee going to $76.53 a paycheck, if the rates currently stand unchanged. Then on page 12 is the PPO. The PPO is the hardest hit for employees coming out of their paycheck change with the subsidy application. Quite a large jump for everybody in the PPL under the current structure if the rates change. And then the HDHP at the bottom also has an increase.
You're saying if the rates don't change,
Yeah.
you mean if the subsidy doesn't?
No, well, so the argument, oh, go ahead.
Yeah, if the full premium rates, the ones that we just presented, if they hold, then this holds. But if these rates come down, they're not gonna go up, but if they come down, then potentially the employee costs come down as well. Could come down.
To recap in a different way, we have tentative agreement from the providers to relook at experience when they have their own experience. So right now, these rates are being based off of the Anthem experience from 2025, which is the whole collective Anthem, not individual plan. So they're looking at everything that Anthem had, whereas their actual individual plan may have very, very favorable experience, but they don't know yet because they haven't been able to look at it in a comprehensive manner since it's only been a few months. So the argument or the proposal is that they're able to get more experience and hopefully see a trend that allows them, with the view of more experience, to commit to a reduction in their rate or a change in their rate that would be favorable and change the employee out of pocket. In these figures, because all of the Blue Shield and UHC plans are increasing in the percentage higher than what the subsidy is, it would be just money in the employee's pocket almost in every setting. Or I shouldn't say that because they're still paying something out, but a better way to say it is be a less impact of increase if the carriers are able to agree to lower their rate based on the experience that they're going to see. And we do have a timeline to be able to do that, since we would need to go to program for open enrollment by no later than the end of next month. So it's a short window.
No, it's just basically, this is the worst case scenario with it.
Right.
This is worst, yeah, this is the
Right.
worst case scenario
Yeah.
that is reflected in the.
Right. It could be reductions, but this is the max we will go for this.
Right.
For this,
But realistically, how much reductions might we be looking at? A couple percent, right?
I mean,
it's like one debate is.
we'll continue to work with our carrier
Sure.
partners to see,
They can get them.
they'll be sharing with us what that experience is and so forth. If it is more favorable, then we'll see, but I think you're right that we're not looking more than 1 or 2 points.
And Paul, when you said that the city, that we met our savings that were projected, you're talking like that 16 million or what, something around that number?
Oh, you mean the budget side?
Yes.
Because of the budget overlap, which is the item D in the action, because of the budget timing overlap, we make an assumption, a rough assumption, an educated guess when we're presenting the budget back in November. And that on the city subsidy side, we had identified or guessed the same percentage that this renewal is coming in at. So there is no cost difference for 2027 that we need to go back and make an adjustment with the budget that was just adopted last week or whatever it was adopted. Those figures are identical to what we've projected so far. But the only changes on the financial side for the city are going to be the regular status quo changes that we have through financial status reports when there's changes in employment or anything else that we didn't expect or we couldn't have projected.
So are we yet able to determine how much savings the city has gained from this transition?
It's hard to make that assumption because we don't have something to go past that for 2027. We don't have what the other plan would have looked like in a renewal to compare. But what we can do is we can say, which is the same thing, kind of the numbers that Keenan has provided, how this compares to overall industry trend, and make an argument that.
Yeah. We also had our underwriters do a little quick analysis relative to had we stayed with Anthem, we had the renewal and so forth, for it to have been better for us to stay with Anthem, the renewal would have had to come in below 1.2% for Anthem, which is highly unlikely. So it was a good move to go to the 3 carrier structure.
One last thing. Just when we switched, the folks that were in Vivity who went to signature value, correct?
It was a mix, but the majority of them did.
And Vivity, they jumped right to this about $70 a paycheck.
They were, yeah, on page 10.
I think
the
it's
top of
60.
page 10.
Yeah, I lost the page, or is it 10? Okay.
Correct.
And then now it's going to 135 per pay period.
If they're in the family plan, correct.
What page was that pie on?
From the deck, it was
Like page 40. Probably.
Oh, I see. Got it. Thank you.
anything else on member out-of-pocket cost or member premium share for medical? And is there anything for the other plans that you'd like to switch back to the deck for?
If there's no other questions on medical, we should go over the dental and the vision and so forth. So on the, I'm on page 53. Or actually 54. The PPO renewal for is 3%. The preventive is also 3.5, but for some reason I'm showing 3% on the next page, and I believe it is 3% for both. So the DHMO is a 0. The preventive plan is 3%, and the PPO plan is also 3% for an overall 2.7%. I'm on page 55. Those are the rates there. And then there's consideration to self-fund in 2027 as well too. And there's a couple of different options that we can take. We would recommend that we go with a 3% increase like we would with fully insured, and that when the city is prepared to hold reserves and so forth, that we move to the self-funding component as well too. Any questions on the dental? Under vision, there's.
Sorry, on
Yes.
the dental, just to clarify from the deck, you have negotiation outcomes, what you guys asked for, and then what they countered with, where we.
No.
Just clarify where we're landing,
Yeah, so
like relative.
on the fully insured, they're asking for a 3% increase. And the underwriting validates that. Whether you self-fund or whether you stay fully insured, it's going to be a 3% increase. Technically, if you look at the trend used, they could say, they're saying it could be as high as 6.7% on a self-funded basis. I typically find that plans perform better than the conservative trend numbers that are used in underwriting. So that's why on page 57, option 2 is really what I think the realistic approach is to put in a 3% renewal for 27 and look to self-fund that. What'll happen is the same concept that I mentioned relative to the medical. The first 3 months are going to be very immature claims where you're budgeting, but you're only paying an admin fee and claim cost to the dental carrier, and you're going to be collecting the full budgeted rates. The balance of what you don't will go into a reserve, and you'll be establishing at first an incurred but not reported, an IBNR reserve. After the IBNR reserve is established, then any margin component that is built into the rates, you're building margin rather than passing that on to the carrier. And that's how you'll accumulate a reserve that will hopefully benefit the city for many years to come as well.
When we did the look back, I think it was for our February meeting, we looked at the self-funding the dental, and then we looked back over 11 years. And over that 11-year period, had you been self-funded on the dental, we had estimated that there would be about 12 million in reserve. So, over, it's the long game with self-funding, but that's where we thought we would be.
I can't believe I've been presenting self-funding that long.
We're almost there.
Wait for it.
Yes. And then this on the vision for 2027, there is a rate pass. So you could self-fund it as well in 27, and I think part of it whether self-funding is something we do or not in 27 will be determined based off the plan experience. If the plan experience justifies the rate cap, then I would say hold the rate cap for the entire year and then look to self-fund. If not, certainly look to self-fund in 27 as well. But right now, the recommendation is the rate cap. I mean, is the
Fully insured.
fully insured renewal at 0%. Terry's gonna.
Yeah, so the last piece is just the EFAP. And because we are going into RFP for that and the timing of that, we had brought up that maybe one of the considerations is to move that renewal to July 1st, 2027. So we asked Optum for some options, like, can we just extend this plan year at the same rate and then renew July. And so Optum, there was some back and forth with them. They gave us a little bit of reduction from the initial renewal, but basically they gave us two scenarios. Like, we keep them in place and we have it with the January 1 renewal, and we have a 2-year rate guarantee. And that would give us like a little bit of a reduction from where we started, or we do a 6-month renewal from January to July. And then that's when we'll have the results of the EFAP in. And so kind of need to make a decision about what makes the most sense there. And right now it pretty much looks like if we do that contract realignment, the increase is about $58,000 for that.
And what would be the benefits for the city to make that change?
Because for the RFP, we're hoping, and typically we do get a lot more competitive quotes during an RFP. And so right now, Optum's kind of like, no, you're going to get a 12% renewal. But if we had those EAP RFP results, we would actually probably be in a better position. So if we postpone the renewal, so to speak, until 7/1, then we can actually put in or consider a new vendor, as well as, just whatever the outcome of the RFP would be. So then, in terms of the other benefits, so your life, disability, your tax advantage plans, so the FSA, the HSA administration, that's all under rate guarantee for 2027. So there aren't any renewals in the deck. But one thing that we did put in is the optional contract, the rate caps for 2028. So I'm not sure what page it is in the 63. So we're showing you what Blue Shield, UHC, and some of the other carriers negotiated for 2028. And there's no rate cap with Kaiser under this scenario. Delta Dental would be on the HMO, there wouldn't be a change for 2028. And then we've got some consideration on the PPO and the preventive plan for rate caps in both 2028 and 2029. The next slide goes into what the projections would be for 2028 if we have all of those rate caps in place and we don't make any other changes. So you can kind of get an idea where this year we're just under that 8% at a $41 million increase. And in 2028, it would be an 8.8% and just under 49 million.
And this is probably a good point to remind the committee that our current contract with all the medical providers is for just 2 years. So we will be making a decision sometime at the end of this year or between now and the end of this year. If we want to proceed with the risk of extending the contract for 2028, given these rate caps and this projection, or if it's a better idea to go back out to bid for 2028 again.
Well, sure. If we were to go out to bid again, I think we've been out 3 times in the last 5 years, and there's a definition of insanity that comes to mind. But I do think we'd have to look at something different, something new, something that potentially would look different and would really require the buy-in of both management and labor. I just recently attended, it was back in Rhode Island, it was the State and Local Government Benefits Associations Conference. California is one of the last safe havens for the HMO products. They went to the East Coast and they've come all the way back. Over there's other models that are being used. And at this conference, there were states that were states that have the population of about the city of LA, that presented how their approach to benefits and so forth. And my big concern always is your HMOs have a huge component, outside of Kaiser, of course, have a huge component of capitation in there. Are we getting the value in the capitation fee? The capitation fee is a set fee that when you sign up for an HMO, you sign up for a primary care physician and you sign up for a hospital should you need services there. That capitation fee is paid to both the provider and to the hospital on a monthly basis, whether you go or not, and covers certain services. My concern is that it doesn't cover enough services to merit the cost that it has, and that claim cost above and beyond what capitation doesn't is really what's driving a lot of the pricing. Now, in the last RFP that we did, we asked for what was non-capitated quotes, which is what the EPO quote was. And I don't think they came in even higher than the HMO quotes. And I'm concerned that those type of proposals were perhaps a little self-serving because they wanted HMO population as opposed to moving to a non-capitated product. But I think there's those type of designs. There's also a new design that is not based off network discounting, but on a concept called reference-based pricing. Reference-based pricing is basically a tool utilized to balance out the approach of what Medi-Cal and Medicare have. What reference-based pricing says is basically we will pay a certain percentage above Medicare, and that's it for those services. It eliminates the network discounting arrangement, or sometimes in a hybrid situation with those network discounts. And so those are the type of concepts that we should, I feel would be beneficial for this committee to explore, and to say, and to look at and see, hey, is this something that we should look at? I'm not saying that we move into anything in particular wholesale, because you're too large. If anything, it's pilot programs that you would need to implement, and see how that works. Reference-based pricing is supposed to give you a 20 to 30% reduction in cost. Typically, we price it at about 10 to 15 in the first year over what your normal rates would be. But that's just one concept, and there is a lot of communication that needs to go out to membership before something like that is implemented. It typically has not a 6-month, but about an 18-month implementation to make sure communications is correct and so forth. But I think we need to start looking at, when we do a marketing, that we look at those type of concepts outside of just asking for the comparable plan designs or minor variations from those.
Can I make a suggestion on that, given that if you're talking about potential, if we were to move down any of those routes, that we would be looking at least 18 months. That already puts us
Close
on
to
the edge of
29.
2028. That's there already. So I think if we're going to even be in a position to talk about those things, I think probably now, I mean, honestly, it's probably almost too late, but now's the time to start putting like detailed information about those options in front of the committee. So I think probably what I would suggest is that we agendize, like we ask for like pretty detailed presentations on what's out there generally, because obviously, I mean, you're bringing stuff up that none of us
Is
are really
new,
aware
right?
of, which is great. But I think we need some actual like detailed information that we can start looking at, understanding what not just the cost impact, but the impact on membership, the impact on the other aspects of the benefits. But I think without some detail in front of us, like really soon, we'll be where we are 2-3 years from now.
Yeah. Well, seeing how this committee has had a nice rest from the underwriting 101 training that we've done. Seems like an education component is due again, and we'd be happy to bring that back to this committee. Thank you.
Thank you.
So that covered section A. Section A items A1 through A9. It also touched on section B though a little bit. So section B is contract extensions or contract discussions. So B1 is saying that we're going to continue to talk with medical. Medical is not a contract extension for 2027. It is a discussion for 2028, but the discussion for 2027 is the experience. So we're going to continue to talk with medical over what they're seeing for experience and the effect on rates. And then B2 is the extension of those contracts for dental, vision, and the Support Plus EAP program. All three of those are ones that we expected to go self-funding for 2027. But the request or the recommendation is to extend them for 1 year while we try to get our 2027 self-funding established. Any questions on A and B so far?
So you talked a little bit about the self-funding, like what would be required, what like for the department, like logistically, basically to do that. Are you suggesting then that you're going to take basically this fiscal year to work out those logistics and be ready to self-fund in 28?
No, the objective would be to try to change at some point in the middle of 2027.
Okay.
And that's actually going to be the C4 recommendation, but we can talk about it now. The plan to move forward would be that we're going to transition to self-funding in 2027 when we were able to, and under the premise that the transition is truly a transition just administratively, no change to the member whatsoever. If there is a change to the member, then we want to plan it to be 2028. But the concept would be that at least under our dental and vision, both of them, we would be accessing the stipulation that they've already provided. We don't know what the EAP one's going to look like until we get the RFP results from that one. But for dental and vision, there is already the self-funding component outlined in there. The services are expected to stay the same. We just need to have the financial and the authority mechanism in place before we can do that.
And I also think it's important to provide us information on the worst case scenario, for instance, if this process goes upside down. What is the financial risk the city has? If it just blows up and goes wrong, what do we have to do to fix it? You know, to go back to what we're doing now, because we need to know what our risk, level is in case this goes south.
Yeah. Unlike medical, dental and vision, the risk is extremely limited because first of all, you have there's a lifetime or there's a calendar year max on your dental benefits. And so you can't exceed that. So, the worst case scenario is that the entire population hit that lifetime max or the calendar year max. And I think it's less than 10% hit it on an annual basis right now.
Just like we prepared financially with the city.
Yeah.
You never know what happens.
Yes. Yes.
And it's good to be always prepared for the worst and just hope for the best. If the worst comes, you have a plan.
Right.
Because when the worst happens, if you don't have a plan, that's not time to develop.
The only anticipated member impact from self-funding or from fully insured to self-funding is I do believe they're going to need a new member ID card. So everything stays the same. The calendar year deductibles continue in stride because we're not changing vendors or anything like that. It's just we're changing the financial mechanism behind it.
So under C4, since we're talking about it, C4 is for a preliminary plan for us to have a communication in place. So we'll be coming back with the committee on a regular basis, talking about where we're at with self-funding and making sure that there's agreement on our steps moving forward and any communication that needs to be done with employees, which is expected to be extremely minimal, is planned out before the transition happens. We can circle back then to no more questions on C4. There are a total of 8 recommendations for program changes in section C. These are changes to how the program works. We can go back to C1. I can take C1. So C1 is a change to the administration of the health savings account. So we had started in 2026 with the new high deductible health plan that comes with the health savings account. And it's required by law to have that HSA for people to contribute to it. We do not have an employer share for 2026. We're not proposing an employer share for 2027. We don't see the savings yet on the premium side to put one through. But for 2026, when we launched the HDHP, we had used Blue Shield's provider or Blue Shield's administrator to administer the health savings account. That means employees do not have a payroll deduction. They have to go to that health savings account, contribute directly to the health savings account. They get then they work with it that way, and they receive tax documents for whatever they do in that outside plan. It is disassociated from the city's process. We are recommending that we undisassociate it and we add it into the city's process. So the same way that the FSAs, the healthcare flexible spending account and the dependent care reimbursement account are functioned, the same administrator is able to and did propose to be able to administer the health savings account. There would be a $1 per member per month charge, which we're recommending that the trust fund pay at least for the inaugural year, and we consider it moving forward. The enrollment in the HSA right now is 126 people, so it becomes a very nominal charge annually to be able to afford to pick up. The administration then would make it easier for someone because then now when they are electing the high deductible health plan, if they should choose, they're also electing with us how much they want to contribute, and it's automatic through their payroll deduction, which is what employees expected in this particular plan option. And then it would centralize things within that administrator. So the action items that are listed are to approve changing the administration from the Blue Shield plan to us or to our administrator, which is our contract administrator, Ameriflex. Then we would set the contribution rates, which at the time that we printed this report, they weren't announced for 2027, and they just got announced 2 days ago as an increase. So to set the contribution rate at the maximum increase allowed by the IRS. And then to approve the payment of that administration fee to come from the $1 per member per month to come from the trust fund instead of coming from employees, at least for 2027. If we move forward with C1 as a recommendation, then the option would allow us to allow for a limited purpose a limited purpose health savings account, which is C2. And that limited purpose option allows for someone who has the HSA, the health savings account, to also contribute or to enroll into a flexible spending account for healthcare that just limits their ability to use that account for medical services. So they would be able to have, under IRS regulations, both accounts available for them to use that are not going to conflict with the IRS reg and create a problem for them. Just to recap, they do the same purpose. The healthcare flexible spending account and the health savings account do the same purpose technically. IRS says you can't have both. You have to, the only way you can have both is if the flexible spending account is a limited purpose that does not allow the same expenditures as the health savings account. We do not have that established right now. So people who are enrolled into the HDHP have to know not to enroll into our flexible spending account. We do give them the reminders, or we did for this year, but it is by doing it this way, we are eliminating or reducing the risk that someone creates a tax compliance issue by enrolling into both. Wanted to add something.
Is this a new tax issue?
It is something that is new for us because we adopted the HDHP with the HSA for 2026. We did not have that plan option before.
A lot of it has to go with, you have maxes under your HSA, and then you also have maxes under your health care. The IRS basically says you can't do both. And so the HSA is predominantly driven by medical plans. And so the limited purpose is, families with kids with braces or braces for yourself where you've got ortho payments, they're going to love it that they can have this limited use HSA or FSA plan because they can pay it there. So dental, vision, other things that are non-medical can be used for a limited use FSA.
No medical, like not even those creams or anything that.
I'm sure there's some exceptions, but that's what your HSA is for.
Okay.
So if you're contributing into that HSA, you should be taking funds out of that if you want to pay it with that way.
And the real big benefit to the member is that these would be both administered by the same administrator. So if they did have a situation where they're submitting a claim and it can't be used under one, it can easily transition over to the other account, assuming they have both under the same administrator. And so the recommendation for C2 is to approve the limited purpose to be added to the benefit menu for individuals to select and to have it match the existing healthcare flexible spending account, at least in contribution and function.
I know it's a really small group, but given how complicated this is, are you guys going to be able to prepared to provide like really specialized communication education to those 126 folks so that because this is confusing for us and we live it, like, they're going to be lost, definitely lost.
Well, just to follow up, I didn't say this before because the group size is so relatively small, but I was really worried about the 175% increase in out-of-pocket expenses for them that's listed for the one category. Letting them know ahead of time would be very helpful to them.
Yes.
Are these use it or lose it, these two HSA and the flexible spending?
The HSA is not. The HSA, everything that is contributed in there stays there forever and goes with the individual. So if they leave city service, they take the account with them. And it turns into a retirement account essentially. The C2, the limited purpose, is use it or lose it, just as the regular flexible spending account is set up. And yes, there will be a lot of education material that we're going to develop. There's already a lot that's out there. It's just navigation.
It's hindsight's 2020, but it's like there was the creation of the high deductible health plan was controversial, and not all of us like the idea. And now it's coming with all these complications for 126 lives. It's just you guys must like to do a lot of work. So I mean, it's just frustrating for me as having somebody not being a supporter of this concept to have their out-of-pocket rate going up 175%, and then you have this complication where they could actually be putting something in, funding something, not understanding it, having the resources go away, and that cost just went up again. It's just frustrating for me. I apologize for being overt in my reaction, but it was uncontrollable to me. So
no, it's fine. The hope is still that the plan becomes popular enough to be cost savings. There's a lot of reasons why the HDHP was looked at and tried to be selected as a plan option, but we did not get from any of the proposals a true cost saving premium on the HDHP, mostly because of population size. I think is a fair thing. I'm not sure if Keenan has a different opinion.
Well, the rate went up 12.9% twice. It's forecast to do it again in 2028. It's a new plan. They don't have experience, and they're driving up the rate. To me, it's they bought the business to create this thing. I don't know what they're using to support the increased rate. I mean, it's frustrating for those of us that were reluctant to sign off on this concept.
But what other option do the employees have if we don't have this?
Yeah.
They don't for as far as for a health savings account, there is not another option that they would have, as far as I'm aware, to be able to enroll into. Is there such a thing as a HHP that's not employer offered?
Through the exchange.
Yeah, through the exchanges, but that's.
They wouldn't. Yeah, they wouldn't be able.
They wouldn't really.
Because although it's not that great, but I think not having it could be worse because they don't have that option. And although it's 126 people, but it's an option we have, and it's a choice they make. And it's nothing mandatory, and they understand what the consequences are if they enroll, but it at least gives them that option and understand the nature of the business. It's earning to make money, and at the same time, if you don't have that option, is that you just don't have it.
But for Keenan, have you seen acknowledged the concerns Chad raised, but maybe they're growing pains? I mean, have you seen the development of these programs elsewhere, and have they leveled out? Have the benefits? I see a lot of benefits to the programs, but have they come to fruition?
Yeah, they have. What we're seeing here right now is, first of all, the anticipation in the RFP was that the HDHPs would be $50 to $100 below the lowest costing HMO. Came in opposite, above it. And because the concept was one of, if it comes in below, is there a city contribution that goes into the HSA, which would be really cool. And you could imagine a lot of people, which are low utilizers, would use it. We didn't get that. So now we're playing the waiting game of looking at what is the plan experience. Problem is we only have 130. Will we get the plan experience, or will the carrier say it's too small and it's not credible yet, which we'll have to wait until the plan experience or until the enrollment grows in the plan. And typically, this was the first year we offered it. Well, we have takers in the second and in the third years, and we typically do see a migration of growth in the HDHP plans.
is the challenge though, to Chad's point, I think it where we are with the cost and the model. You know, when the model is what we kind of expected, that growth every year, like people start looking, oh, that would work. That would be less costly for me. But when it's not, where's the draw to assume that it will get, you know, another 100 people will decide to take a more expensive, less valuable benefit.
So the ones that are taking it are those that typically they would have taken the PPO plan instead, but look at it and say, look, I don't use it, but I want freedom of choice. I don't want to be tied to a primary care physician. I don't want to be tied to a hospital. I want to be able to get the care that I want. And they look at themselves and they say, I'm relatively healthy. And they say, this is a lower costing PPO plan. So that's who we have enrolled in that right now. Certainly for future consideration, and just, you know, do we offer an HDHP amount, because that has to come in lower than the full coverage, and maybe that's another step that will come back and we'll provide. I'm adding my education list here to this committee.
I mean,
So,
maybe the 40% increase in the PPO cost will drive some movement too as well.
yeah.
It's the population are those who are impervious to disease, right?
Well,
People like you.
it's
Absolutely.
yeah, it's typically, you know, yeah, it's your younger population that they fear an accident, but there is no sickness kryptonite for them. And
There
yeah.
are population
Yeah.
So targeted marketing would, I mean, that's what we really have to engage in if we want to be successful. Is hey, you know,
Are you
I'm gonna stereotype, you know, young male, 20-year-old who never goes to the doctor and has nothing wrong with them and never will.
Yeah.
22.
And that kind of,
You turn 22 and then it's down
It all
to.
goes.
you know, I think that brings up another thing that I think would really benefit this committee is what we could do is kind of look at who's enrolling in what and do what's called a workforce analysis. So dig a lot deeper into the matrices of age, gender, demographics, and so forth that really make up each group so that we have a better understanding of who's enrolling in what and why, so that we can formulate a strategy going forward that hopefully can smoothen the tide a little bit that we're on with.
Just if you look at it, it's probably usually based on income.
That too, yes.
And in this, like it says, targeting a group and letting them know what's out there and why it works into their advantage.
Yeah.
And then with educating, whatever like that, because the average 19-year-old working for the CLA is not in that group.
Yeah. Yep.
But using the data you collect to help educate them on their options. You're in this plan. Maybe the other plan would suit you better. Even if it's a little more expensive or if there are other drawbacks, the benefits that what you see might help people with better choices. Which is what we want. I mean, that's waiting through the stuff is fun. I mean, how long does it take everybody here just to wait through the stuff? I mean, it's gotta be daunting for the average person who just doesn't need. More work.
I listen.
Okay.
I got a sidetrack. You were about to tell us about C3.
Yeah. So for C3, moving on to C3 is the dental subsidy maximum. So for this, we are, well, let me just go over the C3 real quick. So currently the dental subsidy maximum is about 85%. We are recommending that the JLMBC approve one of three potential actions. So action one would be no change, where the subsidy would be kept at 85% of the PPO employee only premium with no further action, or for the JLMBC to consider a future change where we keep the PPO, the dental PPO subsidy at 85% for 2027, but potentially look at an increasing it for 2028. Or the third option would be just to change that subsidy now for 2027.
How would that be paid for in 2027?
The overall cost change is expected to be 1.6 million based off of the current enrollment. It would be an adjustment to the FSR for moving forward for the first part of 2020. Well, technically it could be absorbed in the fiscal year for 27, 28. But that would be the overall cost increase. And I would like to add to what Chang said, this subsidy authority is somewhat unique. On the medical side, it is hard written in the code and everywhere that we're linked to a certain plan. Dental does not have that. This change to go to 85% was done by the committee 13 plus years ago. And so that's why we were wanting to reaffirm, since it's been such a long discussion, how the committee would like to continue with dental.
So option number 2 is essentially a report back.
Correct. So you can questions, ponder on your thoughts. Continue on to, if there's no other questions, we did discuss C4 already.
So we'll move over to C5, the cash and lieu program eligibility changes. So this is a follow-up to several reports that we've presented over the past few months. So at the last update, we had informed the JLMBC of the survey results and the cash in lieu costs. And essentially, the gist of it was that in most instances, it costs the city more to offer a cash in lieu benefit to the employee as opposed to having the employees enroll into their own medical coverage. So for C5, we are recommending a policy change where we limit the cash in lieu only to city couples where the city city benefits from a decreased subsidy cost.
So you're saying what, one person could get the cash in lieu if they're a couple?
We would only allow employees to enroll into cash in lieu where there is the city isn't where the city will gain a savings.
So does that mean it's case by case basis or?
Each year when the premiums change.
Mm-hmm.
So and so on page 29, Chung has a chart that shows for 2027, looked at all the premiums for 2027 proposed. And the only situations where there is not a cost savings for city couples, specifically city couples, to cover each other as dependent, is on the employee plus spouse coverage for every plan except for the UHC signature value plan. So right now, this has been happening in current year as well. So an employee that, take Kaiser for example, an employee and another employee who choose cash in lieu, the city is paying $50 per paycheck to the cash in lieu employee, but then pays an additional premium because the cost of the premium for employee plus spouse is $90 more expensive than two individual premiums for the exact same coverage. So this change means nothing to the actual experience of the employee, except that they're losing out on the cash in lieu of $50, but at a benefit to this, or a cost savings to the city for not overpaying. We would look at this again every single year or when the premiums change, and then revise our affidavit to make sure that people are understanding that which plans are eligible to enroll into. for cash in lieu. And then the only result would be the individual is automatically enrolled into employee-only coverage instead of being a dependent on their spouse or domestic partner. We did look at the situations for all other relationship types. So city couples that cover a child, city couples that cover the family rate and the employee plus child rate still wind out to be a cost savings for the city. It is only employee plus spouse that ends up being a disadvantage financially.
So
And
it's
this
good
is
for us if the employee plus spouse start having kids.
you could look at it that way, I guess.
You said also in that situation, the solution, the proposed solution is to have both employees like on their own insurance, so not
Correct.
one dependent on the other.
Correct.
So I mean, that becomes the impact. Like that's a impact on your family because now you have to figure out, like it's changing how you do healthcare, right?
It would be,
You have to go tell your doctor, oh, I have a new health plan.
it depends.
It could be the same health plan, right?
Yeah, they would be, we would put them, so if someone is trying, in this current scenario, if someone is not making election change on their own, they would be in the same health plan. It would just be the employee only, so they get their own card instead of the card of their dependent, but in lots of cases, it's the same card. They're not gonna see a change. The only change is the administrative side of where they're enrolled. And they would still be no change to access doctors in the scenario, no change to PCP.
Would they be able to be in different plans then?
That would be election part on their end. Correct. They can't do that as a cash in.
But with a vendor, you get a number 1, 2, 3, 4, 5. Whether you're dependent or you're the primary, that's still 1, 2, 3, 4, 5. It's not going to change. Is that what you're saying?
Could you restate the question? I'm sorry.
So my wife is the same employee. I work for a private company. I'm carried, or I'm sorry. No. We're both city employees. We're gonna say that I'm gonna take cash in and she's the primary. We're Kaiser members. My Kaiser record number is 1, 2, 3, 4, 5. Now all of a sudden, Kaiser's out. No more cash in lieu for couples. So now I have to go enroll at Kaiser. Do they make me get a new medical record number?
I think Kaiser is unique. I can't speak to everything logistically for all the carriers, but I think Kaiser is unique that your record number stays the same. At least that's what we've experienced before.
But then to Matt's point, that there might be some disruption because if I'm with a carrier and I'm a dependent, I'm 1, 2, 3, 4, 5 prime because my wife's 1, 2, 3, 4, 5. Now all of a sudden I'm
Getting a new number.
on my own. Now I'm 4, 5, 6, 7, 8. So I have to remember that number. Right. Okay. Just
Yeah.
take it in
It's the
fact.
least
Yeah.
of the impacts on our memory.
Apologies, just a quick reminder. When speaking, if you could please speak into the microphone, it would be appreciated for those members of the public and staff who are attending either telephonically or through the YouTube app. Thank you.
So we did put a cost example on page 29 as well. This is and maybe this is even more important. This is only applying to city couples based on current enrollment. City couples that have this, and city couples specifically, who are not in the UHC signature value plan, because that one is identified as a cost savings for the city. If we have that, there is a total of 95 people. Sorry. I think that was total including it. So it's about 90 people total that this would affect out of the 1,200 that are currently receiving cash.
You're thinking like I'm thinking, right?
And those 90 people alone would be a cost savings of $377,000 annually.
Solves that problem.
Should have started with that.
So can I just ask one question just to clarify this? The chart with the purple header, with the red numbers on the right-hand column.
Yes.
Where you see a red number, it costs more money to insure them as employee and spouse or dependent as opposed to two premiums.
The column on the right that says difference that cities cost.
Yeah.
As far as savings go. So in the very top one for Blue Shield Trio, the city is paying an additional $94 that it didn't need to per paycheck. I believe is the rate.
Is that inclusive? Does that take into account or assume any cash in lieu, or is that just
It's
straight?
just premium.
Okay,
So
it's straight premium.
$50 on top of that 94.
Yeah, so it's $94.32 more expensive to have a couple sign up as spouse with a dependent as opposed to two individual employee premiums.
Correct.
Okay.
And just to drill it further, so for that very first one, the employee plus spouse premium is $1,036 per paycheck. The single premium, the individual premium, is $471.28 per paycheck. So that is when you double the individual premium, there's no getting past that. That is where the savings.
Understood.
Okay. C and
Moving over to C6, actually, the basic disability. Yeah, basic disability benefit increase. Just looking for my page. Okay.
So this is, we haven't done this in a couple years because we did a major change in 2025 of changing our disability benefit altogether. So the history of the disability benefit, there's a difference between the premium that we're paying and the benefit that a member receives. And the benefit that a member sees is on the basic level that nobody pays, at least the employees don't pay anything for, has a cap, a maximum amount per month that is paid. It is based off of the employee's salary, 50% of that salary, up to that cap. When we went out to, and that was always around the $3,000 a month figure, has been growing over time. And then we went out to bid, we said we wanted to increase that to $5,000 per month, which we did. But that was a huge change, 34% increase change in benefit. So we did not make any cost of living adjustment or any decision on changing the benefit amount for 2026. It is the decision if we want to consider that for 2027. We are in rate guarantee with the carrier for this plan through the 2027-2028 year. So there'd be no immediate change on rate that we're paying for premium. It could have an effect later on for renewal or moving forward on something else. But it would be a question of, is there a need to increase the benefit for a cost of living adjustment? In doing that cost of living adjustment, what we do is we look at the overall salary increases, how things have happened over time from one point in the year to another point in the year across the membership as what was negotiated by the city for salaries. And apply that as a weighted factor towards the overall benefit itself. So if there was a decision based on the past practice of how we've calculated the cost of living increase to increase the benefit, it would be $157 a month increase to the benefit cap. That only applies to still the 50% rate itself. So looking at who that applies to, the reason why we went up to $5,000 a month is because there was a lot of people that were making a wage that was really capping off of. When we go to $5,000 a month, it's here somewhere. It is really affecting anybody who makes more than $57 an hour. That is where the threshold is currently hitting. So that is the decision if we want to increase the benefit maximum at to be at $5,157 for 2027.
Without me having to do math right now, do you know what that annual is, the 57 hourly?
No, I have to do math too.
118.
118?
Right, maybe a little more than that.
Yeah.
119. 119,016, 57 an hour. There you go. Just double the number. 2,088 hours in a year. Sorry. Double the number, 2,088 hours in a year.
I feel like it wasn't louder. Just laughing about you speaking to the mic. I was like, I don't feel like it was louder.
It's for the digital.
For the oh yes.
Any other questions on disability? Okay, next one.
So for C8, we are recommending allowing employees the ability to elect waiving out of enrollment from one of our benefits. So as background, we have traditionally offered the cash in lieu options for employees who to opt as an opt-out for the medical. If we were to remove the cash in lieu option, we also wanted to introduce an option for employees to waive out of coverage entirely as well. So the LAL program has not traditionally offered this option, so it would be the first time that we are providing this to employees. So, approving this would allow any eligible employees to opt out of the following benefits: medical employee only, dental employee only, vision, basic life, and basic disability. It would also require employees to complete a waiver form for the removal of the basic benefit and require that the employee acknowledge and agree to the any applicable compliance requirement. Third, it would require an annual attestation or reconfirmation. And fourth, it'll allow for changes to be aligned with any applicable life event, but not an administrative change.
I'll add, it is not common, but we do get employees who ask to just not have anything. And we have not offered this before. It is historically, I don't think we ever did. So go ahead.
Well, and just to add a little bit more background to that, typically we would get these requests from employees who have coverages elsewhere, and they want that coverage to act as primary. Whereas in a situation where if they have coverage through the city, the city coverage would be, could be the primary for them, and they don't want that city coverage to respond first. So adding this waiver option would allow the employees in this particular situation to have a choice as to which plan that they want to respond to, which medical plan they want to respond to first.
What type of benefit is that your situation is? Are you talking what?
Typically, we've typically seen it, or at least I've typically seen it more for medical, where they want their other plan, or if they have coverage
They
for
already have
health.
the option, right, with the cash in lieu?
No, with. Go ahead.
So there are certain populations, half-time employees. So there are certain populations like half-time employees who have, or in certain situations, depending on their MOU, that are not eligible for cash in lieu option. And so for these employees, these are typically half-timers in particular MOUs that are required to have that half-timer cost to their and as we all know, because of the premium, the subsidy max, that can be more expensive to a half-time employee. And this is a smaller population that would not be eligible for cash in lieu benefits, but because they are locked out from locked out of cash in lieu, they don't have any other option of waiving the city's coverage that may be more expensive to them. So that's one population that this would help.
So I think what Mindy's trying to say here was that this would be an additional group that could benefit from having this opt-out option. But could you please repeat your earlier question?
Talking about having them opt out or the ability to opt out of any basic benefit, right? Like disability, life insurance. Why is that a benefit to the employee, and what would the incentive to them be to do that?
Well, for medical, like I said, it's usually if they're in a situation where they have coverage elsewhere.
Medical, I can see,
Yeah.
but the others.
Dental, we have seen it as well. As for the basic disability,
The dental? there are employees who dislike the options that we have for dental. There's also because of the structure of the dental subsidy, we don't have a cash in lieu option for dental unless they are enrolling into we have a preventative option, but we also have, or if they are enrolling into a union-sponsored dental benefit. And we have had many employees express that they would like an option to not enroll in dental. Very rarely do we see it for vision, life, or disability. But if we were to consider an option that has been requested at some points for dental and medical, we would like to consider it for all of these benefits.
And just to add further, it truly is just preference. It is just the individual who may have whatever the reason is for not wanting to, being angry at us because they're saying they're forced to take something that they don't want, right? And so this is removing the forced perspective. It is still something the employee would have to physically elect and do. We still do not see this as being a popular option, nor even one that would be regularly used by a population. Go ahead.
So we're not a true cafeteria plan. Would they be getting the value of what the city would have been paying as cash? Or they're just opting out and they lose whatever value the city was?
That's a good question. So yeah, if we were a true cafeteria plan, we'd be paying somebody only if they did not opt out, correct?
Yeah, in a true cafeteria plan, you have a dollar amount available for benefits and then you pick and choose. But yet, even within a cafeteria plan, there oftentimes are mandated employer benefits, life, disability sometimes. Those are two of the more common ones.
Right, but we're saying that the benefit to the employee is that they get freedom of choice. We're not saying that they're gonna get the cash value of the thing they're opting out of, right?
Right.
Okay.
I see that it would require a waiver and an annual attestation or reconfirmation. Is there any risk of liability
That's a good question.
by allowing people to waive out of these benefits for us?
And that's what we want the waiver to cover.
Okay.
So we want to, we do want to talk with legal and make sure that allowing someone to do this is fully covered in that waiver, that they are attesting that they understand and they're not creating risk for the city. There is still stuff to cover on that to make sure the language is correct. But yes, that was the objective of that.
In making the recommendation, have you considered the administrative burden and the liability of you guys getting the not having a current designation on file and having somebody waived out of life insurance, let's say, or disability insurance? Is the juice worth the squeeze? I mean, because you guys have to administer this. You're taking on liability that you don't make an error.
And that would all be part of the waiver process, right? Like somebody.
No. I opt out of disability insurance this year.
Correct.
You guys don't get help me. Thank you very much.
Then you don't.
And the next year I'm opted out, but you don't have it on file, and now I'm disabled. Do I have a way to sue you because you didn't remind me, but through clerical error?
But administratively, those two things have to be connected. So we would not be able to accept the opt-out or process an opt-out if we did not have the attestation in place.
I understand that, but okay.
So but I understand where you're.
Yes,
going.
the city's taking on an additional administrative risk.
I think what you're saying is that it's better off just to worry about people being mad versus covering the city liability wise for one or two people. Is the risk there?
Yeah.
I think it is, it is always a difficult thing to balance between the people that are adamantly upset that they're being required to have coverage versus the overall outcome, right? Or that level of risk.
But by having them having coverage, does it adversely impact them?
It can.
Yeah, because I was going to ask the opposite. Is there a risk that we accrue by not allowing people to opt out?
Right.
because there could be damage. I don't know what kind of damages people could suffer by having a plan that they didn't intend to have and they wanted a better option, and then we not provide that.
Like,
And that's
are people mad at,
The-
are people just mad or are they suing you? To get out of it.
If I might. For me, I understand the dental and the medical because that comes up and people are disadvantaged because their spouse might have better insurance. They're not have, they don't have it's not available to them because they're double insured basically.
Right.
But as it relates to the disability and life insurance, I just don't see, to Marlene's point, what is the upside of me not taking life insurance, or how am I disadvantaged? I don't understand why those two categories are on this list.
There's no cost.
Right.
The overall objective is that is comprehensive, that everything is identified as fully optional to the employee. So that's why everything's on the list.
Yeah, I just think it's.
The overall, and to circle back kind of to something that you had identified, it really the current risk right now, the only risk is disclosure. Does somebody understand? Are they told that they have the insurance that they have until they have a bad outcome? That is the current thing that we're facing. Have we been sued by it directly? I'm not aware. We only get involved in the that particular action of it when it gets down to a certain point. But I don't know that there's other risks. We can definitely look at that and take it back and come back if there is not a clear recommendation from the committee as proposed.
I also think it's important we look at other agencies that offer that and see exactly what they do and what, measures they're taking to protect themselves legally.
Also, I mean, I know we were talking about administrative burden, and I understand that we are burdened often with not having resources, but it seems to me that also requiring like a counseling session associated with it so that we can be clear that people understand what it is they're waiving, as opposed to allowing them to waive in a vacuum might be an appropriate approach if people are giving up a benefit. And like, we at this table can't see a logical reason why someone would maybe want to give up their life insurance benefits. But so long as we know that they have received appropriate information about what it is that they're giving up, then, I don't mind giving people the latitude to do what they want to do. People do all sorts of things for weird, reasons. I don't want to say weird reasons, their own reasons, but that might be an added protection where we've clearly provided the information, we've received a waiver, we require them to do it every year. And if they take that action on their own and of their own volition with all the information, then maybe we give them the option to do that.
And about how many people are we talking about?
Yeah, it's unclear.
Oh.
We get a handful of requests.
Yeah.
Mostly new hires, but we get a handful of requests each year. So I would argue in us talking about this and how we looked at it, that it'd be an extremely minimal number of individuals in our overall population.
We need a little bit more information.
Yeah, as your consultant, I have no problem with the medical, dental, and vision. On the life insurance, there's two concerns that I have. One, so a city employee waives and then dies.
And their beneficiaries don't.
And there's nothing there. It could be bad press for the city relative to the minimal savings that's received through not paying the life premium. The other is I waive coverage, then I develop cancer. I wait to open enrollment and now I join again. So your risk profile improves by people waiving to a certain extent. And then as adverse selection, as people have things happen to them and say, I better get some life insurance, so I'm not going to sign that attestation. Now you got the roller coaster going the other direction again. So from my perspective, I would be very cautious moving forward with a waiving of basic life, and then kind of the same concepts relative to disability as well too.
Does someone have to disclose a pre-existing condition for a minimal coverage like that?
No.
Okay, so we wouldn't, so.
You wouldn't, but they would know I got cancer now, I'm gonna join the plan, so
Yeah.
in case I do die or I need to, they come on specifically just so that they can now go off on disability.
But it's a benefit they would have already received anyway.
Yeah.
Yeah.
I just feel like people might, inadvertently elect, or like sometimes we see people not behaving in their normal way, they do things that they don't remember doing, I just see it opening up a door for negative impact on the employees.
Like sit here and think about all the times I just click agree to the terms and conditions.
Yeah,
to get to the next
maybe,
thing.
but they don't read everything. I mean, I get that with, I don't think people read everything thoroughly. I don't like it.
But sometimes in this particular situation, because it's real sensitive, do you want to protect them from themselves?
Yeah.
And in the worst case scenario, if they're over insured or whatever like that, they have it and we'll thank you later for not taking them off. But especially with some of the new hires and the younger individuals coming, you just don't understand.
Maybe
I
the
think I'll
department
be-
can just
Oh,
come back with
yeah.
Yeah.
a little more detail on maybe what it would look like to just do medical and dental
Mhm.
and like numbers and logistics around a plan like that.
Yeah, I think, yeah, I'd be interested in knowing, like, yeah, how about if there's like how often it happens. If there's a way to be able to quantify it.
Would there be an option to restrict that since it sounds like we're really talking almost exclusive, not completely exclusively about part-timers? Maybe that's an option only for part-time. I don't know, just something to think about, because I don't know, thinking about full-time and the costs and benefit, I can't think of a scenario where it would really make sense for a full-time employee, but with the part-timers where the cost of insurance is like your premiums that you pay are higher, and especially if you're a low hour employee, like making that cost out, that I could see how that could really not make sense for you financially. But if you're a full-time employee, like you're probably best off having the insurance.
Well, no, there are scenarios where that's not the case. Like, for example, my wife's insured to the school district. I don't have city insurance, by the way. Our kids, they determine who's primary based on some formula. You'll know what it is, right? I should remember, but I don't. I might want the primary to be my wife's insurance, and she might want that for us. But because they're mandated to take medical insurance, they're not. Somebody leaned against the switch.
Yeah.
Yeah, they're telling us this thing is need to wrap up. It is 11:05.
Okay.
Yeah.
Fine.
Energy conservation.
Yeah, so anyway,
Okay, I mean, so if the department just can come back with,
Yeah.
responses to some of the concerns and issues that brought up today.
So then if that item is going to be continued, the last item in the C section is the typical change for the maximum to increase the maximum for the healthcare spending account. There is no option to increase for dependent care. The last two parts of this report are the program update for financial. So on page 35 is the proposed budget, that $433 million that's listed there for civilian benefits planning is the same figure or the same estimate that we're coming in at right now. So there's really no update for budget to be concerned about. And the last item is adopting the overall plan program, which will include the motions that you decide to act on for section C. So there's no further questions or recap need. The request or the recommendation would be to for someone to consider as a motion for section A to move forward altogether, for section B to move forward altogether. On section C, there does need to make a decision on C3. And it sounds like the committee wants to continue C7. Not include that in the motion.
So I'll move everything you just said, A and B and C, on C3. I'll move that we, given the other premium increases that we have, I move that we push it back up to 100. And then yes, continues to 7.
Second.
So C3 change now? Is that what you said?
Yes.
Just to read our legal counsel, is that clear?
Yes.
Yes.
Okay, just to recap, for this report, the recommendation would be to approve A1 as the A recommendation as a group, the B recommendation as a group, and then as for group C, C3 would be recommendation to approve the change to 100% PPO subsidy. And then for C7, that will be brought back to the JLMBC at a later date.
C8.
There's a typo.
On but just to clarify for the typo, the continuation is the opt-out waiver. Continuation.
It's C8 on my, that's on my schedule. It's
C8 on
C8.
mine.
It's C8 in the report
the
and
grid
C7
plan.
on the agenda.
Yeah. Get it.
Oh, okay. I'm gonna get the grid. I'm sorry. Apologies.
Nope, you're in the right place.
And then to continue,
You are.
or to approve C1, C2, C4, C5, C, all the other Cs.
Has it been seconded?
Yeah.
Yeah.
Okay.
Yes.
Oh, I'm good with the motion.
Oh, okay.
Sorry.
No worries. Okay. Switch. Okay. I will now take a roll call for the votes. Malika, your vote.
Aye.
Tony, your vote.
Aye.
Matthew, your vote.
Aye.
Paul, your vote.
Aye.
Patrice, your vote.
Aye.
Janita, your vote.
Oh, yes. Now, yes.
Marlene, your vote. Chad, your vote.
Aye.
And Lisa, your vote.
Aye.
The vote is unanimous. The motion passes as amended.
Thank you very much for that. We'll move to informational items. Committee Report 2615, the Dependent Eligibility Verification Services Update.
So good morning, just jumping right in. The audit is now entering its full-scale implementation phase with final results expected in July. This report summarizes the progress made since our last update, current activities, employee communications, and upcoming milestones. As a reminder, the purpose of the DEV audit is to ensure that all dependents enrolled in benefits meet established eligibility requirements. Conducting periodic dependent audits is a standard benefits administration practice that helps maintain program integrity, ensure compliance with LAL rules, and safeguard public funds. The committee approved a two-phase audit approach this past March, and staff has continued to work closely with SACOBA to implement that strategy. Phase 1 focused on reviewing dependent eligibility documents already on file with the city, including historical records received from TELUS and documents voluntarily submitted by employees during the 2025 open enrollment period. In May, SACOBA completed its review of these records and successfully verified 3,754 employees and 9,427 dependents. Employees whose dependents were verified during phase 1 will receive a confirmation notice and require no further action. A sample of that can be seen in attachment A. Employees whose documentation did not meet current requirements or for whom documentation was not available, they will move into phase 2 of the audit process. Phase 2 represents the full employee-facing portion of the audit and officially begins this month. This phase will include approximately 9,500 employees and more than 18,000 dependents. Employees identified for phase 2 will receive individualized verification packets that outline the specific documentation required to verify dependent eligibility, and a sample can be seen in attachment B. In addition to the audit being conducted by SACOBA, employee benefits staff will conduct a concurrent review for special dependent populations, including domestic partners, children of domestic partners, adopted children, legal guardianship, grandchildren, and disabled dependents. Staff determined that these dependent categories involve policy nuances and will be better suited for internal review.
So, a significant amount of work has been completed thus far to best prepare employees for the audit. Staff and Secova have distributed initial announcement letters and targeted email communications advising employees of their audit status and encouraging them to begin gathering required documentation. An example of this can be seen in attachment C. Following our communication outreach, staff received a large volume of employee inquiries primarily related to document security and the need to resubmit eligibility documentation. In response, a citywide email was sent to provide clarification regarding the audit's purpose, security protocols, and submission requirements. A copy of that email can be seen in attachment D. Secova will continue a multifaceted outreach effort throughout the audit via reminder emails, automated notifications, and text messages to encourage member participation. To support employees throughout this whole process, staff has developed a dedicated dev audit microsite on keepinglawell.com. The microsite includes an overview of the dev audit, frequently asked questions, and document submission instructions designed to help employees successfully complete the verification process. Our documentation verification guideline is also available to assist members by highlighting the current eligibility process and including clear examples of acceptable and unacceptable documentation. In addition, staff has been working closely with Secova and our ITA team to implement single sign-on functionality. SSO is scheduled to be integrated into production by the end of this week, as it will provide employees with a more efficient and secure method for accessing their employee portal and submitting documents for their dependents. Member verification packets are scheduled to be mailed out by this week, with employees expected to begin receiving their notice during the week of June 8th. And our current deadline for document submission is July 3rd. Once the audit period is complete, staff will begin reviewing appropriate dependent terminations, evaluate any applicable premium recovery actions, and begin transitioning into preparation for the 2027 open enrollment cycle. Staff and Secova remain actively engaged in supporting employees with their respective deadlines, monitoring project milestones, and ensuring a successful completion of both phases of the audit. Thank you.
So if somebody doesn't receive their packet in the mail, snail mail, is there a way for them to?
Yeah, so we requested that Secova give us copies of the verification packet sent to members, but they also confirmed this week that they are able to have members request them either online or calling them and requesting the packet be resent.
So there's no totally digital way of doing.
So the SSO functionality that we're building in essentially is the verification form just online. So we're also, it's not necessarily outlined in what we said, but we're also creating like a security document or SSO kind of guideline to help direct members on how to navigate the portal. And the portal essentially is the verification form, just, not paper.
Okay.
So I was wondering too, because I saw like all the attachments, but is there like some sort of like kind of one-sheeter that we might be able to help support you, like when we're out talking to our members with a QR code that we can have them direct to the microsite to do that? I know that we've forwarded your information to like our call centers and stuff so that if our members call in, then they have what they need to be able to try and help direct them to the instructions you gave. But if there's something that
we're in the process of creating something. So as Gabby and Karina kind of touched on, the dates and the documents or the dates for launch were yesterday. There's a slight little delay, but we're expecting to go live before this week is over. And then part of that will be exactly that. It'll be, you don't have to wait for your documents to come in mail. Go online now. And if you're the majority of the population, you can just access it through your city email through the SSO link. But if you're not, and you need to go directly to the website, we'll have that instruction in that. So we can definitely make sure that you have that as well. so that you can help people get there. And that's what we want. We want people to take action now. We want them to go on correct as soon as possible to verify their dependents and not wait any further than they need to. Once the system is live, which is expected by the end of this, that's tomorrow, expected by the end of this week.
Were you able to identify any trends among people who moved from phase 1 to phase 2, people who enrolled in benefits within a certain time frame, or certain types of people who did not have their dependents like verified up front? Did you notice any trends, or you haven't been able to look at that yet?
I think one thing that stood out a little bit and is a hard conversation to have with employees. We did see a number of people give us documents that are not acceptable. So what we allow when somebody has a newborn child is for them to provide their hospital verification because they don't have their birth certificate at that time. We are not accepting hospital verification through this process because there is no reason why a birth certificate should not exist at this point. And so we did see a number of people have that hospital verification resubmitted when they did the voluntary option, or that hospital verification was still the document on file because that person had not come back and there's no reason for them to give a birth certificate until now. So that seems to be the highest trend, is just the understanding that even though you had a document submitted, that's not the document that applies anymore. You need to have something different.
These documents are being kept on file this time?
Correct.
Last time they weren't, right?
So last time they were kept, just to say something completely fully, they were kept on a very protected disk that no one has access to.
Okay.
So
that's
they
the
were very
question I've
protected.
received, like what happened to my last documents?
And then
losing my documents.
Well, so that was the digital version that was done through the audit.
Uh-huh.
The physical documents are in record retention and they're not kept in an order, nor that would be practical for us to look at. Nor does it say, and that's another thing that we've had difficulty in talking with employees about, nor does it say that this person is attesting that person is still in coverage, right? So if someone had given us a document 10 years ago, we don't know until they say something that they agree that person's still supposed to be there, that there hasn't been a situation that person should have been removed. So we do need to have an action, even if we did have that document.
Is this the second audit by Sakova or still the first?
Well, second
confused.
is in phase. So Sakova, you want to go ahead?
So I don't know who did the first one back in like 2014, but
No, that predates me by a lot.
okay. So what back in March when we did it, we're
Yeah.
doing phase 1 and phase 2. So it's
Okay,
two
this is the
different.
second phase of the
Yeah.
initial audit. Okay, now I understand. Thank you.
No other questions? All right, thank you. Moving forward, John, do you have anything?
Okay, just to recap, I believe we did receive 2 follow-up items from the JLMBC.
Okay.
First up is a report back on options for the medical benefit, and I think on medical to the JLMBC, including cost impact and member impact. And I think then the second item was a follow-up for staff to report back on item C7 from the program report, which was the waiver of the benefits.
Okay, any other requests? If not, we can move on. We do not have a date for the June special meeting.
At this, yeah.
Okay, there is no anticipated June special meeting. The July 2026 meeting is canceled. And we have August 6th, 2026 as a regular meeting. And if there are no additional items, then we can adjourn at 11:22.
Thank you all.
I'm like, I miss you, Paul. We on the same circuit.
Please chat.
Yeah.
Exhausted now. That was a lot. What? It's just a little, employee benefit.